Good morning. It's Monday, the 11th of November, and this is Govindraj Ethiraj, headquartered in broadcasting as well as streaming from Mumbai, India's financial capital that's usually but in transit right now. The Take. A Marwari industrialist once explained to me why they were into multiple and diverse businesses in response to my question on whether there was a dilution in focus because there was no emphasis on any particular industry and thus core competence. Now, core competence was a big theme a couple of decades ago. The industrialist narrowed it down to two things: risk linked to business cycles and reward linked to opportunity. According to him, business cycles were such that it was important to be present in multiple areas. For example, when textiles were down, steel might look good. And if both were down, maybe a finance business would gain traction. The other was, of course, opportunity. Every decade had seen and is seeing new business opportunities, including sectors which at that time were not open to the private sector. Needless to add, industrialists have constantly diversified and expanded. Hence the growing importance of conglomerates, where ownership and control rests with a single individual, family, or entity to which or whom the profits also flow to. I was reminded about this larger debate on conglomerates versus core competency or focusing on one industry on reading Leader of India's opposition Rahul Gandhi's recent column in the Indian Express, which appeared to attack some conglomerates for their proximity to political power, where he also alleged the use of that clout to intimidate mostly other smaller businesses into submission or takeover. And I quote him, "When you compete with them, you're not competing with a company, you're fighting the machinery of the entire state," he argues, also adding that these groups decide what Indians read and watch, they influence how Indians think and what they speak. Today, market forces do not determine success, power relations do, he argued. To digress a moment, the examples he uses as a contrast to the big monopolists, as he termed them, also seem somewhat misplaced. Many of them are startups funded by overseas venture capital who are essentially trying to replicate or were trying to replicate a venture in China or, for that matter, the United States. For example, an Ola is an Uber of the United States. But the problem is that they also created significant market distortions in the process, for example, by driving up labor costs or causing migrations which were never sustainable. Looking not too far back, most of these investments have already turned lemons and more will, including some of the listed ones, in which case the investing public will carry the cross. Now let's return to conglomerates. There is another reason for their success in continuance, which is that they're mostly family-started, owned, and managed enterprises. Now, this is not just in India, but across Asia, for example, where family-owned businesses represent almost 80% or more of all businesses. Now, to take some names from back home, the Ambanis, Tatas, Birlas, and Adanis are conglomerates in multiple businesses and also constantly scouring for new opportunities, some in the old economy and some new. The Tatas, for example, came back into airlines, but are also now one of the key drivers of India's semiconductor ambitions. The Ambanis ventured into telecom, retail, and then entertainment from their original businesses, first of textiles, then petrochemicals and oil and gas, and then what we see today. The Adanis went from ports and cement to power, solar power, and now data centers. The Birla Group recently launched a paints brand and a retail jewelry brand. The paints brand is an extension of its cement portfolio, and jewelry its retail portfolio, which includes garments. Now, the linkages, and I have not quoted all the examples, are not too difficult to see. It's also inevitable that conglomerates with multiple interests will also engage with the government and attempt to influence policy from different quarters. Their combined bargaining power, if you want to call it that, will be higher than any individual business person, and maybe for good reason. Now, Mr. Gandhi is obviously referring to a crossing of lines for which he has not presented any specific example or proof, and nor is that the key issue here. The larger question, at least in my mind, is the importance of conglomerates. An economy like India, driven by family-owned businesses, will inevitably create more conglomerates or see the expansion of existing ones. Such a structure works well not just for the business groups in question, but also for other stakeholders like lending institutions, shareholders, and employees. This is because conglomerates also have the ability to raise capital in tough times using their combined or other balance sheets and maintain general business stability. And we've seen that happen. Now, Mr. Gandhi says that banks should overcome their fascination for the top 100 well-connected borrowers with their attendant non-performing assets and be made to discover the profit pools in lending and supporting the play-fair businesses. Now, there's no denying that conceptually, but many of the top 100 borrowers are also likely to be in conglomerates or part of conglomerates with strong balance sheets in that universe. And while there will be and have been some very bad eggs, investors also trust conglomerate managements because they feel that there is demonstrated capability in one industry which is good enough reason for them to invest in the next. So a recent example is the Ambani's financial services foray, Jio Financial, where the stock has been quoting at a solid premium to listing last year despite having any real business to show yet. So all of this means is that conglomerates work for the economy as a whole, including, of course, in creating formal and relatively secure jobs. Now, there is a last reason for conglomerates, and that goes back to my conversation with that industrialist, which is succession. The next generation, particularly if there are multiple inheritors, will want or demand businesses to run. The Ambanis and Adanis have clearly demarcated businesses for the next generation, and more visibly with the former, as Mukesh Ambani, Reliance Group chairman, has publicly indicated. Now, that also presents an opportunity for fresh direction and value creation, and of course, continuance of family business traditions, ownership, and wealth. And that brings us to the top themes and stories for the week. FIIs have now pulled out about $12.5 billion since October. Why that market overhang will continue. Crude oil markets are trying to make sense of the Trump victory. And the rupee hits a fresh low as a strong dollar continues to reign. Gold prices are down. Where could they go from here? And diabetes is the highest cause of deaths in Mumbai now. What that means for you?
This is a Core Report with Govindraj Ethiraj.
Markets struggle to hold ground. The Indian markets were down on Friday, ending the week in the red, even as foreign investors continue to dump stocks over, among other things, concerns over slowing corporate earnings. The markets have now posted losses for the fifth week, and the Nifty is down 8% from the record high it hit on September 27. Just as an aside, analysts or strategists that we've been talking to have been telling us to expect and brace for a 10% correction from peak. Foreign investors have now pulled out close to 13 billion since October and have been net sellers in all 29 sessions from September 27th to November 8th, according to Reuters, who also said that FIIs are withdrawing mainly to invest in China, drawn by Beijing's stimulus measures and the stock market's relatively attractive valuations. Incidentally, I picked this up from another report. Many other markets like Indonesia, Malaysia, South Korea, Taiwan, and Thailand have also seen FII outflows in November, but the amounts are smaller in contrast to India because their markets are also smaller. On Friday, the Sensex fell about 55 points to close at 79,486, while the Nifty 50 fell 51 points to close at 24,148. Elsewhere, almost quietly, because all attention was on the elections and Donald Trump's victory, the Federal Reserve on Thursday cut interest rates by 25 basis points, but also indicated a cautious approach to further cuts. The markets, as we've been saying for a while now, have been pricing in a Trump victory for several months, but the extent of the win was most likely a surprise. While there will be bullishness on Wall Street for some time, it's unlikely to spread to India as the overhang of weak results will take some time to overcome, and there are other macro considerations which we will come to shortly. And also a pure supply-led spike in prices. When I say supply, I mean funds flowing into the markets, including through mutual funds. And that seems unlikely because any rise would trigger selling, particularly by the smarter and, of course, institutional investors. And that brings us to the rupee, which has hit a fresh low thanks to that continued selling by foreign institutional investors. And the rupee weakened to a record low on Friday, logging its worst weekly fall since May, according to Reuters. The rupee is also under pressure from a stronger dollar, which we pointed out, which has only strengthened since the Trump victory. The rupee closed little changed at 84 rupees 37 paise against the dollar after declining to 84 rupees 38 paise late on Friday. The previous low was 84 rupees 37 on Thursday last week. Inflation to jump. So we've been talking about the sharp rises in tomato, onion, and potato or top prices last week, leading to higher costs of food items for households. Not surprisingly, consumer price inflation for October or last month is now projected higher at a 14-month high of 5.8% in October, primarily due to that spike in vegetable and edible oil prices, a Reuters poll of 52 economists has predicted. Now, this will be the highest since August 2023. If so, and inflation has already risen to about 5.49% in September, higher than forecast. Food prices, which make up nearly half the inflation basket, have shot up in the last month. Reuters also reported that the government's move to raise import taxes on edible oils by 20 percentage points in mid-September also helped drive prices up faster, further straining household budgets. Edible oils in general have actually helped keep inflation low because their prices have been falling. That's the international prices. Of course, now that's changing. Oil searches for direction. Oil prices fell after Chinese stimulus measures disappointed speculators, but not enough to move prices from their narrow trading band since July, according to Bloomberg. Oil is currently trading at just under $74 a barrel or $73.87. So investors are in a wait and see mode to see if Donald Trump's election victory will lead to peace in the Middle East and, of course, the Russia-Ukraine war. Crude is also under pressure because the Organization of Petroleum Exporting Countries Plus is delaying its planned output hike by a month. Gold prices fall. Gold prices fell at the end of a volatile week's trading as investors assess the path ahead for US rates and the implications of Donald Trump's election victory. And bullion has fallen by as much as 1% on Friday, on track for its biggest weekly decline since May, according to Bloomberg. Gold gained on Thursday after that Federal Reserve rate cut, even as Federal Reserve Chief Jerome Powell said he did not rule out or in a further cut in December, which obviously suggested that the economy was still expanding solidly. Strategists at UBS told Bloomberg that gold will likely see support as a hedge against the inflationary pressures of high US government borrowing. Gold is up about 32% this year, with gains powered by heightened geopolitical and economic risks. Spot gold is now at about $2,686 an ounce and was down about 2% last week. Silver prices, by the way, too have fallen for the second weekly drop, says Bloomberg. So what is the outlook for gold prices in general? And back home, where we've also seen prices fall, but also then demand had slowed in the festival season because at that time prices were higher. And then on the other hand, we have the wedding season ahead. I spoke with Surendra Mehta, National Secretary of the Indian Bullion and Jewelers Association, and I began by asking him how he was seeing the recent fall in gold prices.
The gold prices have been falling because, first of all, nobody expected, at least the gold industry never expected that Trump could win. Everyone thought that this is going to continue. The US will continue to be in debt for years together now if the other government is elected. As soon as Trump won and he gave his first comment, so he said that he is going to cut the corporate taxes and he's going to ensure that US is out of debt trap, which is 36 trillion almost, by way of, he says they have a lot of oil and gas reserve and he can clear the debt through oil and gas. That is the reason why, the gold market started falling, because it is also a known fact that he would not like the geopolitical tension to continue. The gold market now expect he would ensure that all the tensions between Russia, Ukraine, Israel, Iran are being settled through dialogue. There is no war in near future. And that is the reason why the gold market started. But how long it will continue, that is a question mark. Anybody would like to see a new president coming and talking sensible things like bringing dollar index up and strengthening the dollar and everything. But eventually, after 7, 8 days, 10 days, we are all again going to look at the balance sheets of US, which is certainly in a very, very bad shape.
What's the medium-term outlook then for gold versus the dollar? Or let me put it this way. Do you feel that the gold prices are going to be essentially determined by the way the dollar is going to move? Or could that relation break?
No, that relation won't continue. Eventually, the gold prices would move based only on the balance sheet size of US. The more the debt, the more the gold prices would. So in my opinion, for the first 7, 8 days or 10 days, the gold prices can go down $2,565 in the international market. Eventually, the market will look at the US economy. It will look at the bond yield. It will look at dollar index, which in my opinion, certainly for first 7, 8 days, 10 days, the dollar index is strengthening. US bond yield is getting better, but I don't think this can last longer. So eventually the gold prices will again start increasing after an initial some.
So now to come to the domestic market, we've obviously seen prices fall by about a little over 2,000 rupees per 10 grams in the last day or two. But there are 2 or 3 other factors. This is obviously we're getting into wedding season. This is still high demand period. How are you seeing domestic outlook overall?
Domestic demand in Indian market, there is going to be a problem with the domestic demand. As we have seen, the demand has already started falling down due to the high gold prices. if this surge in the prices continue for another 1 year or two, because a 30% rise in price in last 52 weeks, if this 30% rise, or even if these prices go up by say 20% on a year to year basis, so which is beyond the inflation in the of the Indian economy, so the demand in Indian market is likely to be hit, and we may see a fall in the gold demand, at least the jewelry demand, by about 15 to 20%.
So this also presumes that you're seeing prices remain high for the next couple of months at least. I mean, through January, let's say.
I see the prices remaining high at least for the next 3 years. The BRICS country are trying to trade among themselves. So what will be the value of US dollars? The de-dollarization has already started taking place, and I think the de-dollarization is one factor which will shape up as the BRICS nations move from one step to another step.
Right, Mr. Mehta. Thank you so much for joining me.
Thank you.
Some corporate news. Singapore Airlines will make an additional investment of about 3,000 crores in the Tata-owned Air India post-merger of Vistara in November. That merger was announced in November 22 and is set to be completed today. That's November 11, 2024, and will result in Singapore Airlines having a 25% stake in the enlarged Air India. Vistara started flying in January 2015 and started off as a joint venture between Tata's and Singapore Airlines, with Singapore Airlines holding a 49% stake. So this does mean, of course, that Vistara's reign in the skies has now ended, at least as a brand. Frequent flyers will continue to see Vistara livery for some time because the Air India management has said that they will keep the two distinct for some time, at least so that there is a clearer transition or a smoother transition. Diabetes, a leading cause of death. Diabetes has become the leading cause of death in Mumbai, with fatalities rising steadily over the last decade. From 2014 to 22, diabetes claimed about 91,000 lives, including 14,000 in 2022, up from about 2,500 in 2014, according to a report titled Status of Health Issues in Mumbai by a non-profit Praja Foundation. The report also attributes about 80,000 deaths to respiratory illnesses linked to deteriorating air quality, while tuberculosis claimed about 45,000 lives in the same period. This Mumbai-centric report also highlights the lack of sufficient clinics and health infrastructure. At a larger level, the diabetes figures might sound surprising, or maybe not, depending on how closely you follow this subject, but the extent of diabetes-linked mortality is obviously worrying. It also stands to reason that if this is the case in Mumbai, other major cities cannot be far behind. I reached out to Dr. Rajiv Kovil, diabetologist and State Secretary for the Research Society of the Study of Diabetes in India, and I began by asking him first if the numbers and the proposition were in keeping with the trends that he was seeing as a practicing doctor.
The numbers are true. Importance is that India as a country and globally, we have moved from infections and other causes being the largest cause of death to NCDs. And if you look at the projections from today 2024 to 2040, almost 75 to 80% of all deaths would be attributed to non-communicable disorders. And in non-communicable disorders, we have diabetes, heart disease, and cancer as the main drivers for the NCDs globally. And whatever is happening globally is also occurring in India. So the Praja report was not surprising at all. It is something that we have been seeing, and we have been seeing these trends over the last 1.5 to 2 decades now.
Right. And why diabetes more than, let's say, heart disease or cancer?
The prevalence of diabetes is higher. 60 to 70% of people with type 2 diabetes have some form of cardiovascular disease, and they die of some form of cardiovascular disease. So diabetes is not just a sugar problem. There are a lot of multiple abnormalities inside, and what you get is at the end that the sugar or the cholesterol or the blood pressure are byproducts of the problem inside. The core defect is inside, and the core defect is wrong deposition of fat in the body, and which may lead to a liver issue, which we call as non-alcoholic fatty liver. You could have obesity, you could have diabetes, you could have cardiovascular disease, you could have hypertension, you could have high cholesterol, you could have cancer. but it's a common soil hypothesis. The origins are the same. They may manifest in different individuals differently based on your genetic makeup, what are the circumstances surrounding you, and what is your lifestyle. It's a common soil hypothesis. So these things will emerge and these things will continue to be the main killers of the society in the next few years or few decades to come.
And in the patients that you interact with, how do you see the acceleration, or rather, where does the acceleration point start, and where does the disease in some ways take complete control, which thus leads to death?
So the biggest problem with diabetes is that in majority of individuals is asymptomatic. And even today, so almost close to 50 to 60% patients do not have symptoms. And that's a bigger problem. So acceptance doesn't occur. So the younger you are, you deny the problem and you feel probably the lab is wrong or something I did in the last few months changed things. So diabetes takes minimum 5 to 7 years to develop. So the acceptance and denial remains for a very longer period of time. And then the silent issue that diabetes has, it carries with it a lot of other known enemies, which could be the blood becoming thicker, cholesterol going higher, the good cholesterol going lower. So it's like a bad friend to have. So it will catch many other bad friends, and together it becomes a bigger problem. So what we have seen is that the complications have also become premature, and the diagnosis of diabetes has come down by at least a decade in the last 1.5 decades.
When you say it's come down, that means?
The average age of diagnosis, like we have an internal data from the clinic, which is 3 years pre-pandemic and 3 years post-pandemic. And we have seen almost 2.5 times more patients as compared to newer patients as compared to pre-pandemic. And the age of diagnosis, which was around 48 pre-pandemic, has come down to around 42. And the newly diagnosed, so-called newly diagnosed people with diabetes, earlier I think had 15% any kind of complications at diagnosis, that has gone up to 30-35%. So that's an alarming rise. And we are seeing 2.5 times more people with diabetes. And the majority of people who are getting diagnosed are in the late 20s and mid 30s, which was not the case a decade back or a decade and or 25 years back when I started practice. I was hardly seeing patients in the 30s, but that's not the case anymore. You see almost 25 to 30% of your clientele who's less than 40 years of age today.
But in a way, is that good news that people are recognizing and turning up faster as opposed to ignoring it?
So an optimist will look at it from that angle, that people are getting more aware and probably going and getting them checked. A pessimist would say that you are getting diagnosis early and probably you need to push yourself for the same amount of years with diabetes, which is the challenge. Now, the younger you are, you have to live longer with diabetes. And there is no structured care of diabetes in our country. And that's the bigger problem. And you have a lot of myths and misconceptions which surround diabetes. And a lot of people want to treat diabetes, all kind of NCDs for that matter. Obesity, which is the driver for all NCDs, including cancer, is not recognized as a disorder as yet. It's considered as a cultural problem rather than a medical problem. So there are a lot of cultural values and traditions which come into treatment of asymptomatic or a condition which otherwise looks benign, which is not, like diabetes. So there are a lot of not just medical problems, there are a lot of social problems which are there with diabetes.
What would you tell people who are listening right now? I mean, particularly, I'm guessing those who've never checked or have checked but ignored because they think that, oh, it's always just pre-diabetic or it's not yet hit the borderline or whatever, the alarm bell line.
It takes a very long period to develop diabetes. So one, accept the problem, do not deny it, seek medical help. There are a lot of ways that a person often believes that if he doesn't take a medication, he's not a diabetic. And you become a diabetic only if you take a medication. It's not, the values actually tell you whether you have diabetes or no. And diabetes today at diagnosis has a lot of people with complications. So diabetes is all about screening for complications. It's not about chasing blood sugars, which was it 30 years back. Today, diabetes is a screening problem where you keep screening for complications, pick up early complications, and there are a lot of ways of treating them. So I think everyone needs to get very proactive about all NCDs, and lifestyle changes which have occurred in the last 2.5 to 3 decades. Our genetic makeup, which helps us store fat and not expend fat, makes us very liable or very easy targets for these NCDs. So exercise, eat right food, reduce your stress. I'm saying, though what I'm saying is not so easy to do, but from a government standpoint, I've always been advocating that the good food or the healthier food needs to be cheaper, more accessible and available to a larger group of patients. And today we see that whenever you go to a health store or a healthy food, it's 3 times the cost. So there needs to be huge taxation on wrong food. All the apps which supply you food at 3 a.m. should be shut. Nutrition should be part of a curriculum in school, so that children, when they go to school, we have physical training, but nutrition, a person eats for almost 70 years of his life. He should know what he eats. So apart from learning all the history of all the people who ruled India, it's better to have nutrition in schools. People should be able to identify food. A child should be able to identify food labels. He should know what is junk and what is not. And that kind of a literate world or a literate population can only prevent these kind of complications. Otherwise, we are going the wrong way, right?
Right. Dr. Kovil, thank you so much for joining me.
Thank you so much, Govind. Thank you. Pleasure being here. Thank you so much.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.